Hello and welcome to Wall Street Vision. On this show, we explore the thinking of the best investors and we examine lessons from the stock market. I'm your host, Vlad Dolgochev. This show is for informational purposes only and is not investment advice. Check out the show notes for the full disclaimer. Hello, Vision Nation. I hope you're staying healthy and keeping well. In this week's episode, we're going to cover the most important fundamental investment lessons that Warren Buffett learned from his mentor, Ben Graham. Let me break this down a bit. There's this article in Forbes where someone asked Warren Buffett for the best money advice that Warren has ever received. Well, Warren Buffett answered by saying that The Intelligent Investor, specifically chapters 8 and 20 of that book, have been the bedrock of his investing success for the past 60 plus years. And if the best investor of all time says that those chapters are vital, they're worth looking into. So in this episode, I dusted off my copy of The Intelligent Investor, and I'll give you guys the rundown of those chapters. We'll cover the most important concepts in them. Now, The Intelligent Investor was written by Benjamin Graham, who was Warren Buffett's investing mentor. The book was first published in the late 40s, and of course, a lot of things have changed since then. But what I like about those two chapters is that they cover some fundamental truths about investing that are still super relevant today. And these truths are going to be relevant another 80 years from now. That's the kind of stuff that's really important to learn because it's the foundation on which you can build other investment thinking. The concepts from the book that are so important are 1. Having a proper attitude towards the markets, 2. Looking at stocks as businesses, and 3. Operating with a margin of safety. There's a few other nice gold nuggets included in the chapters that I'm going to mention as well. Alright, let's dive right in with Chapter 8, Biggest Takeaways. Here we go. The first key point is all about having a proper attitude towards the markets. For anyone looking to invest, especially if they have a high percent of stocks in their portfolio, they should expect some volatility. That's a given. The book says that you want to have the right expectations. If you're going to go to a CrossFit class, you can expect that you'll be out of breath and sweating. If you're investing in stocks, there's going to be some ups and downs along the way. Basically, the prices of stocks fluctuate for any number of reasons, and that shouldn't scare off investors. Ben Graham even goes to say that there is a decent probability that at some point, most of the holdings in an average portfolio will increase by 50%, which is great, but they will also decline by over 30% from their high points. That's the expectation that a stock investor should have. That's already a great little gold nugget because it addresses the importance of having the right mindset in investing. Ben Graham is pretty much saying that if you can't stomach the thought of having a 30% paper loss in your portfolio, you shouldn't have a portfolio that's all stocks. And that totally makes sense because a big drop in value like that is realistic. So his recommendation there is to have an appropriate portfolio based on your willingness and your ability to tolerate risk. Why is that important? Well, because if your portfolio is all stocks and you're a risk-averse person, when the inevitable drop happens, you'll probably be tempted to sell, which could be something that causes you to experience actual losses instead of experiencing paper losses. Now remember, a loss doesn't become a true loss until you sell. The second key concept is that when you're buying shares in a company, you're essentially a silent partner. You're actually a part owner of the business. This is a very different mindset than the mindset of an active trader in the market. If someone bought a gas station or a restaurant, they wouldn't be constantly checking what that business was worth on a daily basis. It would be silly to do that, because the value of the business would only change over long stretches of time. But there's a lot of people out there that check their portfolio balances on a daily basis. In a way, it's unfortunate that stock prices are quoted every second, because that can create the sort of habit loop where people constantly check their account balances to see how much money they've made that day. And remember, short-term fluctuations are mostly random. They've got nothing to do with the actual performance of the businesses. The way the book lays it out is using this great analogy of Mr. Market. Picture this: you're a silent business partner and you own a coffee shop with two other business partners. One partner is Mr. Market and the other partner is Joe. When you set up the business with Mr. Market and Joe, everyone put in $100,000 of capital. Joe worked super hard setting up this coffee shop, and it's now the neighborhood fixture. And you've got great Yelp reviews, and the business is doing really well, and you have tons of followers on Instagram. Now, Mr. Market is a really neurotic sort of a person. He gets freaked out at times, and other times he's in euphoria. And there's no pattern to this. Sometimes it changes day to day, and sometimes it changes week to week or month to month. One day, Mr. Market feels amazing, and he tells you that he's going to buy you out for $150,000 because the business is doing so well and it's all wonderful. Then the next day he comes in, scared out of his mind, and he tells you that he'll offer you $50,000 to buy your share of the business. He comes back day after day offering different prices. The point is that the prices he gives you are kind of random, and it would make the most sense for you as a business owner to ignore his price quotes and instead to understand how the business is actually doing. Is the business selling more coffee cups today than it did a year ago? What are the margins that you're making? Is there a chance of starting up a franchise? And so on. Those are the types of questions that are more important to focus on instead of focusing on the price that Mr. Market is quoting you for your share of the business. So the lesson Warren Buffett took from this analogy used in the book is to ignore the noise of prices in the stock market and to figure out on his own what the right price of a stock should be. Warren Buffett operates in a place where he just thinks of the economic value of a business, which is often different from the quoted price of a stock. These seem to be the same things, but really they're very different. So Warren Buffett just thinks of how much is this business worth. He ignores the quoted prices that get shown around on news networks because that's just noise and it doesn't always reflect the true value of a business. If I buy 100 shares of a company this morning because I did the analysis and figured out that the company is undervalued and they'll have good growth prospects and that most people don't really appreciate this, and let's say by the afternoon I've made a 4% gain on that stock, does that make it a good investment? Really, that's just a random fluctuation in price. But if I look at the price in 2 years and the stock doubled because some of the things that I predicted with the company actually ended up happening, then sure, that was a good investment. It takes time for businesses to gain value. It doesn't happen every few hours or every minute. A business gains value by getting more customers and improving the services and products that it sells. That doesn't happen quickly. It's a slow process that takes months or years. We've probably all known of an entrepreneur that became successful, and the process is usually over many years. A friend of mine has a pool servicing company, and he started the business over a decade ago. Today, they're doing really well, but it was a gradual process of building up the business by providing a great service to their customers. Of course, with some newer business models, this can happen more quickly, but the key thing is to understand that it takes time. A business usually doesn't get suddenly more valuable. You might be saying, well, there's exceptions to this, which is true. Maybe there's an announcement that the business got a new contract that's going to increase revenues by 30% or something like that. But those types of things don't happen all the time. The obsession that most people have on checking market price numbers on an hourly basis is unhealthy, and it encourages them to take too many actions. And there's research out there that shows that overactive portfolios usually don't perform as well as the buy and hold portfolios. It reminds me of an old interview with Jeff Bezos where he was talking about the stock crash that Amazon saw after the dot-com bubble burst. Amazon stock went down by a lot, and the reporter asked Jeff Bezos if he was concerned about it. Well, Jeff's reply was that the stock price and the business were two different things. The stock price went down, but all their business metrics like number of customers, gross margins, packages shipped, and so on were all improving month after month. So there was a big disconnect between how the price of the stock was doing and how the business was performing. The point is that the quoted market price doesn't always reflect the true value. A lot of times, it is approximately right, but that's not always the case. So it's important to be able to tune out what's happening to the market price and instead to focus on the actual business economics. That covers off the key takeaways in Chapter 8. Now, Chapter 20 is all about the margin of safety, which is a concept that Warren Buffett has talked about so much over the years. Before we dive into the margin of safety, I'll quickly mention that if you're enjoying this podcast, please give us a rating and follow us on your podcast platform. And if you know someone who would benefit from this type of content, please share this episode with them. My goal for the podcast is to help people learn the lessons from the best investors and to help people understand the stock market better. I think that's important today as there's lots of information out there that can lead people on the wrong path, and I would love for more people to benefit from this type of content. Alright, back to the show and our discussion of the margin of safety. So the margin of safety essentially means buying stocks at a discount. Just like you try to buy a pair of shoes when they're on sale, it's good to buy stocks when they're on sale as well. So getting a little more technical here, the margin of safety principle is basically when an investor comes up with their own estimate of the true value of a stock, and then they buy the stock for less than that true value. Let's use a simple example here. If you have a stock selling for $60 per share, and you estimate that its true value should be $100 per share, and then you go to buy it, then you're buying it with a margin of safety, assuming that the business has good long-term prospects. When you buy a stock for less than it's worth, you're essentially reducing your risk. Even if your calculations are off, you're still being conservative, so you have a safety buffer with the investment. It's interesting how even in this book, which was published years ago, Ben Graham talked about how a growth stock can still have a margin of safety. In a conventional value investing type of thinking, you'd look at the past performance of the stock, look at the financials, and then make predictions on what the future would look like. That's what Warren Buffett did when he bought boring businesses like railroads or See's Candy. He just projected out the cash flows into the future. What Ben Graham is saying is that a growth stock can still have a margin of safety. Maybe the company is not making a lot of cash flow now because it's reinvesting all the cash that it generates back into the business. So a growth type company may not look very profitable today, but you can still figure out how much the stock should be worth by making some conservative predictions about the future. Maybe they would stop reinvesting in the business and instead start paying out cash as dividends to the investors. That's just one example, of course. The key thing is to make the predictions conservative and not to use highly optimistic scenarios in your analysis. So it is possible to purchase a growth stock with a good margin of safety. Of course, using the margin of safety concept doesn't guarantee success, but it does improve the probability of success. To summarize, the key lessons that Warren Buffett has learned from the book and that he uses in his investing today and has used for the past 60 years are 1. Have a proper attitude toward the markets. 2. Look at stocks as businesses. And 3. Operate with a margin of safety. Alright, Vision Nation, that wraps it up for this week's episode. If you've enjoyed it, please hit the subscribe button, leave a review, and if you know someone who's interested in investing, please share this episode with them. Thank you, and I hope you have a great day. This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. I may maintain positions in the securities discussed on this podcast.